Are we on the verge of economic turbulence? Dive into expert insights with Luke Gromen's take on U.S. fiscal deficits, Kerry Stevenson's bold mining moves, Steve Hanke's election predictions, and Chris Whalen's recession concerns. Uncover why liquidity, geopolitical shifts, and market sentiment could reshape your financial future. Don't miss out. Like, subscribe, and stay ahead of the curve. Today on Financial News in Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money, we have Luke Gromen, Expect Market Turbulence Ahead Due to Tightening Liquidity. From Kitco News, we have Australia's bold mining moves, Why the Aussies are Investing Abroad, Kerry Stevenson. From David Lynn, we have Who Will Win 2024 Election, the best prediction tool according to economist Steve Hanke. From the Julia LaRoche Show, we have Why the Fed is Worried About a Recession Next Year, Chris Whalen. Welcome back to Thoughtful Money, where insightful conversations meet practical advice. Today we've got Luke Gromen, founder of macro research firm FFTT, offering his expert take on the global economy. The crux of the discussion is the escalating concern over the U.S. fiscal deficit and the resulting tightening dollar liquidity, which Luke believes could lead to significant market volatility and a looming sovereign debt crisis. His thesis is that the U.S. is on a collision course where deficits indeed matter, threatening the purchasing power of the dollar and economic stability unless policymakers intervene with considerable liquidity injections. Here are the key points discussed by Luke Gromen: U.S. fiscal deficit and global growth. The U.S. fiscal deficit has surged to about $2 trillion, demanding a large share of global GDP growth just to service its debt. Luke points out the deficit's rapid growth outpaces both U.S. and global GDP growth, exacerbating dollar liquidity tightness. Dollar liquidity tightness. As deficits drive slower global growth and a stronger dollar, we may see significant market volatility and a possible recession. Historical patterns suggest repeated intervals of insufficient dollar liquidity, leading to more volatility and pressure on different asset classes. Impact on global markets. Foreign entities holding $57 trillion in U.S. dollar-denominated assets will feel the pinch, leading to forced sales of treasury bonds, potentially driving yields up and slowing both U.S. and global economies. Strategies for uncertain times. In tight liquidity environments, own the dollar and gold as safe haven assets. Once policymakers inject more liquidity, switch to shorting the dollar and staying long on gold and other assets. Luke Gromen made the following predictions. Market volatility. Expect significant market turbulence across various asset classes until policymakers inject more liquidity into the system. Sovereign debt crisis. The U.S. could face a sovereign debt crisis if current trends continue, leading to a severe depreciation of the U.S. dollar. Federal Reserve actions. The Federal Reserve will likely be forced to provide substantial liquidity injections to stabilize the markets and support the economy. Luke concludes that the U.S.'s fiscal deficit is unsustainable without intense liquidity infusions from the Federal Reserve, pointing to a potentially massive repricing of risk assets and a weakening of the dollar. His call to action is clear. Keep an eye on dollar liquidity, manage risks by holding assets like gold and T-bills, and brace for policy shifts aimed at stabilizing the increasingly volatile economic landscape. Hey folks, welcome to another exciting episode on Kitco News. Today, our host Jeremy Saffer is on location in sunny Boca Raton, Florida, covering the Rick Rule Symposium on Natural Resource Investing. Joining us is Kerry Stevenson, the brain behind the Making Money Matters podcast and the Australian Gold Conference. Kerry's here to talk about Australia's bold moves in mining and why they've got their eyes set on foreign lands. In this video, Kerry Stevenson explores the current sentiment and future outlook for the mining sector, particularly focusing on why Australian investors are flocking abroad. With a strong background in resource investing, she suggests we are on the brink of a commodities supercycle, driven by the global transition to renewable energy and the growing demand for critical minerals like copper, silver, uranium, and rare earths. Here are the key points discussed by Kerry Stevenson: market sentiment and transition to renewables. Positive investor sentiment driven by the anticipated global shift to renewable energy. Increases in commodity prices, with gold up 24%, silver 49%, and uranium a whopping 60%. Australian investments abroad. Australians are investing in mining opportunities abroad, especially in regions like Canada's Athabasca Basin for uranium. The connection between Australian and Canadian mining sectors due to similar jurisdictional benefits. Importance of due diligence. Kerry emphasizes the need for thorough due diligence, such as knowing the company management and avoiding investment based on social media tips. Management having skin in the game and reasonable compensation are key indicators of a company's potential. Mergers and acquisitions, M&A, a potential M&A boom driven by the necessity for companies to consolidate for survival. Challenges in M&A due to egos and the conflicting interests of managing directors. Government's role in red tape. Critique of increasing governmental red tape which hampers project development. Conflicting government stances on energy policies, especially noted in Australia's ban on nuclear energy, despite its large uranium reserves. Kerry Stevenson made the following predictions. Resource supercycle. Kerry suggests we're at the cusp of a major commodities supercycle, driven by the energy transition. She advocates for looking at long-term investments in critical minerals and gas plays, as these will be in higher demand. Economic realignment. Predicted economic realignment due to unsustainable fiscal policies, such as excessive money printing. Kerry anticipates a correction, as governments can no longer kick the can down the road and will face the inevitable financial consequences. Kerry Stevenson wraps up by highlighting the importance of long-term thinking and due diligence in resource investing. She is bullish on real assets like gold, silver, and property, and advises investors to look out for undervalued opportunities while keeping an eye on macroeconomic trends. As always, Kitco News is here to keep you informed and ahead of the curve on all things investing. Welcome to the David Lynn channel. Today, we have a stellar lineup of topics featuring the legendary Professor Steve Hanke, Professor of Applied Economics at Johns Hopkins University. We'll be diving into the 2024 U.S. election predictions, the latest about France's political climate, and the yen hitting a 38-year low. Hold on to your seats as we decipher the markets with insights sharper than your wit. Professor Hanke argues that betting markets provide a more accurate and real-time gauge of election outcomes compared to traditional polls. He discusses the dynamics of the 2024 U.S. election, recent French political shifts, and currency markets to validate his point. Here are the key points discussed by Professor Steve Hanke. Betting markets versus polls. Hanke emphasizes the superiority of betting markets over polls for election predictions due to their real-time data aggregation and the financial stakes involved for participants. He cites historical accuracy and the real-time nature of betting markets as key advantages. 2024 U.S. election discussed, current odds showing Trump at 61% and Biden at 17% on Polymarket. Highlighted the betting market's ability to incorporate all available information, including economic factors, debate performances, and public sentiment. French presidential election. Hanke notes that both betting markets and polls failed to predict the French election outcome. He criticizes Macron's decision to call an early election and the potential impact of proposed leftist policies, including a 90% top marginal income tax rate, yen versus dollar. Detailed the factors contributing to the yen's depreciation against the dollar, including low monetary growth and the carry trade. Highlighted the yen at a 38-year low and the impact of Japanese monetary policy focused on interest rates rather than money supply. Professor Steve Hanke made the following predictions. U.S. 2024 election outcome. Professor Hanke believes betting markets will continue to give a more accurate prediction as we approach the election date. Mentions the current odds favor Trump, but acknowledges the unpredictable nature of politics. French political impact. Predicts a hung parliament in France, leading to political paralysis and a weakened position for President Macron. Foresees potential economic turmoil if leftist policies like high tax rates and wealth taxes are implemented. Yen versus dollar. Anticipates the yen will remain weak unless there's a policy shift to increase the money supply in Japan. Speculated that a change in the global economic landscape could also impact the carry trade dynamics. Professor Hanke's core message is clear. Betting markets are a robust tool for predicting election outcomes due to their real-time and objective nature. While he acknowledges imperfections, Hanke maintains that betting markets outperform traditional polls. He advises viewers to consider these market insights while keeping an eye on upcoming global political and economic events. Welcome to the Julia LaRoche Show, where finance meets flair. Today's guest is none other than Chris Whalen, a man with many hats, chairman of Whalen Global Advisors, author of The Institutional Risk Analyst, and a go-to investment banker and analyst. Chris is here to dive deep into the concerns that the Fed, the ever-watchful U.S. Federal Reserve, has about a potential recession next year. And spoiler alert, he's got a lot to say about it. The central theme of this engaging discussion is that the Fed is increasingly worried about a looming recession next year. Chris Whalen breaks down the various indicators, including Fed-assigned stress test numbers and volatile microeconomic data that suggest serious concerns about economic stability, particularly within housing and commercial real estate sectors. Here are the key points discussed by Chris Whalen Macro View Update. The economy shows a mixed picture, with areas such as housing slowing down significantly, barely managing $1 trillion in mortgages last year, compared to the $5 trillion boom of 2020-21. Volatility reigns supreme in weekly and monthly economic data, further complicating predictions. Fed stress tests. Whalen criticizes the methodology of the Fed stress tests, arguing that they reveal more about the Fed's insecurities than actual bank health. Example: Ally Bank has an assumed 40% loss on its credit card book, twice the amount given to Capital One, suggesting deep concerns about consumer stability. Consumer credit and defaults. Consumer credit and defaults are the big question marks. A surge in credit card and auto loan defaults could make headlines and impact political landscapes significantly. Whalen draws attention to consumers being forced to sell their homes to manage debt, highlighting a silent crisis. Commercial real estate. Commercial defaults often go unnoticed unless significant, but are increasing, particularly in cities like Chicago. Issues extend to older, less occupied properties seeing devaluation due to newer developments. Political implications. Whalen speculates that Biden may step aside in the upcoming election, yielding the Democratic baton to Kamala Harris. He suggests a Trump win could be beneficial for the economy due to less regulatory friction, but acknowledges potential backlash if recession hits under Trump's second term. Chris Whalen made the following predictions. Recession next year. Expecting a recession driven by commercial real estate woes, which will trickle down to affect employment and consumer confidence. Indicators include massive value destruction in commercial properties and a shift in consumer behavior from refinancing to selling homes. Fed rate cut post-election. Whalen predicts the Fed is likely to delay rate cuts until after the 2024 elections to avoid political implications. Chris Whalen paints a vivid picture of a precarious economic landscape influenced by volatile data, consumer credit woes, and political dynamics. His main call to action? Strap in for potential turbulence ahead and stay informed. For businesses, this means preparing for a possible recession next year and keeping an eye on Fed's maneuvers post-election. And, of course, make sure to follow Chris's thought-provoking insights for more updates. In this video, Gromen warns of market volatility due to tightening dollar liquidity and looming fiscal deficits. Kerry Stevenson highlights the opportunities in the commodities sector, propelled by the renewable energy transition. Steve Hanke argues betting markets offer more accurate election predictions, while Chris Whalen cautions about a potential recession driven by consumer credit and real estate woes. Even though they disagree on the specifics, all experts stress the importance of staying informed and prepared for economic shifts. Tune into our channel for continuous updates and strategies. Thanks for watching Financial News and Review for July 9th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.